Hi everybody, this is a presentation based on a guest lecture that I delivered in summer of 2022, and I've uploaded it here so that it can be easily accessed by the attendees, my students and colleagues. Now this is on a topic that might be a little bit obscure or a little bit niche at first, but certainly it's one that's growing in importance and one that will be very relevant to built environment professionals in coming years, and that is this valuation of build to rent properties, also known as the PRS market, or the professionally rented sector. And what do I mean? Quite simply, residential homes that are let to tenants by an institutional landlord, as opposed to, say, private landlords or private individuals letting a property to a tenant, or those who rent from local governments or through a housing association. Now, the concept of build to rent is not new, certainly not in Western Europe. It's been quite normal, but it varies from country to country. In the UK, it declined somewhat after the First World War. Various rent control laws or rent protection laws evolved so that private developers had no incentive to build such properties due to the falling income, and instead they delivered other properties for sale. Other countries are a little bit different. Certainly, if you look at major German cities, renting from a private owner is completely normal and has been for decades. In fact, I was speaking to a German colleague who told me that in Berlin, the rent control is so tight that many citizens there, many Berliners, do not want to own a property, as it is more expensive than renting. In the USA, the centre, I believe, is known as multifamily housing, as opposed to condominiums, which is when individuals own their own apartment. In the UK, the recent evolution over the last 10 years has been rather rapid, and the offer, i.e. the quality of stock, has been getting better. Some recent report I read that around 35% actually of new homes delivered in London were by the build to rent sector, and that was up from about 20% 1 year earlier. In general, it's a lack of affordable homes to buy that actually drives this market. Most users, most tenants, would still prefer to own their own home, although it is said that younger people, the so-called Generation Z, may think differently. Also, over the last 5 years, we've seen a demonization of smaller landlords who were seen to be making the market unfair by buying up properties and making it difficult for younger people to get on the housing ladder. There are also obviously additional purchase taxes and stamp duties now, and there is a law actually that changes how we offset mortgage interest costs. This sort of ever-tightening legislation on energy efficiency and sustainability further makes offering rental properties expensive for individuals, to the point that they're actually leaving the market. One important feature is that the daily routine of the renter, or the average renter, and the renter profile, is actually now built into the initial design. Developers are marketing communities that match tenant lifestyle, so it's not uncommon to find communal areas and other facilities within these properties. One of the main drivers behind growth is the possibility and the attraction of long-term stable income streams, to the point that we're seeing over the UK over £4 billion per annum of investment into the sector, and that's something that's expected to continue growing. Growth is estimated to be as high as 50% per annum, and actually has been for some years, since at least 2015. First of all, we'll think about some benefits for investors. This is an opportunity for institutional investors to diversify into a different sector. They may already have significant investments in industrial, retail and offices, and this is an alternative that is in a different property cycle. And an obvious recent example of this is that while retail and offices might have suffered during the pandemic, people still needed places to live and therefore are still paying rent, although they may choose, of course, to be outside of a city centre. What else? Oh yeah, letting risk is low. There's actually such little supply at the moment, and the cost of buying your own property is actually out of reach of many in the larger cities, and that makes renting necessary. Void rates are also low. Actually, the market is highly elastic. So if a property does not let in a month, you can reduce the rental price by, for example, £50 and quickly secure a tenant. With logistics or retail, offices, warehouses, a unit can be empty long-term, perhaps years, and can be a significant hole in income. Whereas here we have hundreds of small units rather than a handful of large units. There are also other potential profit centres. Schemes can take advantage of economies of scale, such as making agreements for utility providers, electricity, gas, telecommunications, internet, etc. And within space, commercial space can be let. There's often retail space on the lower floors. Can also fit in gyms. What else? Laundrettes, vending machines. I don't know. The possibilities are actually endless. The tenants are themselves actually a rather captive market. There's also advantages from transaction costs. If you were looking to buy a lot of retail properties, well, when you buy a single complex where you're buying every single apartment, you're actually just having one transaction rather than 100 or 200 smaller transactions, and the costs are much different as opposed to when you try to buy apartments separately. Finally, one other thing about these is that these buildings are mostly new and usually built to very high standards of sustainability. There are a lot of green features, and this provides opportunities for investors to improve the greenness and the ESG factors of their portfolios. There's also benefits to tenants, of course, and the main reason driving the market from demand side is a lack of affordable properties for tenants to purchase. Although, as I mentioned already, young people might be coming more averse to home ownership anyway, preferring flexibility and the ability to move around within cities, within countries, or even continents. Some features on site can be unlimited, actually. They can be social spaces, gardens, additional storage. Larger schemes might offer a cinema, co-working space, residence lounges, among others. Larger Class A schemes might include spas or a swimming pool. These are possibly not exclusive to those living in the scheme. Often when there's commercial operators, these could be open to anybody from outside the scheme, but they maybe offer discounts to those on site who perhaps take a membership. Features can vary depending on the size and quality of the scheme. Costs will also vary, of course. This will depend on amenity. Quite common though, and this is a huge benefit, is that often rental agreements are attractive. There can be occasionally no key money, sometimes no deposit. We can have variable lengths of leases. It's something similar to like a serviced apartment or an apart hotel in some cases. If you want a 3-month lease, then that's not a problem. You move in, no need to contact the gas or electricity company to get connected, or the internet supplier. It's already there and already included in the price. More and more common is to see even an exclusive mobile app to inform residents about any issues or even social events if the scheme is large enough. Residents can inform management of anything that needs fixed, needs serviced. If there's something broken, that app can also help tenants inform the property management. Usually, or very often, especially in larger schemes, there are caretakers and handymen on site who can deal with any problems quickly. And of course, obviously, these features come with a cost. As the sector grows, we'll see different offers of amenity and prices emerge. This photo here is one taken, it's actually, this graphic, it's better to say, it's one taken around in London and close to Wembley Stadium. This is a company called Quintain. They're a very good example. They offer over 8,000 apartments here at this location in various buildings, each offering a different level of design and different lifestyle choices to suit different budgets. And it's possible that someone could move into a property at the start of their career, find a partner, marry perhaps, move into a larger home within the same development and maybe start a family. And move into an even larger home still, assuming they still enjoy living in the same place. So let's have a run through the sample valuation. Now, these are actually quite straightforward. The approach itself is simple, but knowing the inputs for that approach is rather specialized. The larger firms, the JLL, CBRE, Cushman and Wakefield, amongst others, they've recently set up specialist teams to advise on such developments and deals and to provide valuation advice. This is still a relatively new sector, and one that's rather different from the traditional institutional investment assets such as offices or retail shopping malls. And as I mentioned already, tenants prefer to pay a single rent rather than have separate service charges for rent, building management, utilities, etc. So there's always going to be the risk of leakage from operating expenditure. By that I mean that is in the running costs. Now the market is still maturing and is fragmented compared to offices, for example. The management in an office building in London itself might not be much different from one in Paris or Frankfurt, Milan or New York, but build to rent is different. We're dealing with many smaller micro markets with different demands and marketing requirements. So let's imagine a typical built to rent building. Let's say here's one that's got 100 flats, contains 100 flats. And for the sake of calculation, we're going to assume that this property is in a major northern English city, Manchester or Leeds, for example, and rental income is averaging £1,000 per month. We're only looking at apartments here, not ancillary commercial space. And I'm using obviously 100 apartments and £1,000 per month as somewhat illustrative figures. This would give us, say, for 100 apartments, £100,000 a month income, or 1.2 million per annum. Now we have a sizable amount of costs: insurance, management staff, which could be security, concierge, and utilities, and some of these can vary widely. And as our figure here is a gross figure, we need to capitalise the net value. So if detailed accounts are available, and the valuer should consider these and compare with the costs on comparable schemes. As valuers, as appraisers, we should really be seeking out as much information about the running costs from the owner anyway. And using those actual accounts in your valuation is also something, it means that it's also something that can be proven in the event that the valuation is challenged. If you don't know the costs, well, we can assume a typical market level. If you have the costs, you can judge, are they unusually high? Are they lower than expected? You might need to think about the management of the scheme. If lettings and management are undertaken by the owners themselves, costs could be lower than if they were outsourced to an external agency. Anyway, you can adjust as needed if you think the property is poorly managed. This is all something that will be based on your own experience. So if you don't have this information, or if you're valuing a new development, perhaps something that's just been completed or in the process of construction, then you need to adopt an appropriate rate in the market in which you operate. Now, in the UK, the increasing number of these properties has shown a typical difference of around 22%. Okay, in this case, 22% costs on 1.2 million per annum, that is 264,000. We also have to assume a certain level of void. This is structural. In any scheme, there's always going to be a certain number of average empty properties. Either they're between lettings, perhaps some properties are being refurbished, or there might be tenants who are there, but they're late with their rent or unable to pay their rent. And this has been observed to be around 3% in the UK. Again, this could differ in the market in which you are working. Now you add these together, 22% and 3% gives us 25% losses. So 1.2 million per annum actually becomes £900,000, and this is our net income. Next stage is to capitalize this by applying a capitalization rate based on an investment yield. Here, looking at some recent transactions, we will be looking at 4%. I must stress that this is before the sort of political changes in the UK, and this, of course, might and the ensuing energy price rises. So I wouldn't be surprised if this 4% had to be moved out a couple of hundred basis points. Okay. If we do use 4% though, applying it to £900,000 net per annum, we get 22.5 million, 22,500,000. Now, if we're advising an investment client at this point, we might deduct purchase costs here. Convention of the market though is not to do this, but it depends on each country. The RICS actually produced a guidance note in 2018 on the valuation of build-to-rent properties, and this is a basic procedure for institutional type products. This income-based method should, of course, be informed by comparable lettings and sales. We can also cross-reference with a breakup value, that is, imagine these apartments were sold separately to end users. What price could be expected at that location? How long would it take to sell each apartment on a vacant possession basis? And finally, we can use the discounted cash flow analysis as well. For an institutional purchaser considering an acquisition, they will attempt to explicitly model the income and test against their own hurdle rate or target rate of return. They can assume their own exit point, and these metrics will be different for each investor. You can also model different scenarios, such as changing rental growth or cost inflation. Now, this is actually from a report from the end of 2021, and it's the UK Build to Rent report by Jones Lang LaSalle, JLL. And here you see that the capitalization rate I used, therefore, is not too unrealistic. I actually asked a colleague who's a director of a residential development valuation team in London as for his opinion, and 4% also makes for a rather easy calculation. Prime regional here says 3.75% to 4.25%. So my 4% falls within that, dead in the middle of that. According to some research I've seen from April 2022, so even more up to date, this is by Cushman and Wakefield, yields in other places are even higher, or rather even lower. In Paris, for example, we're looking at 2.1% for these similar developments. That's probably the sharpest in Europe. Now, I'm going to look quickly at the types of deal involved in these properties. So basically, there are three types of deal that you might be asked to appraise. And the first we've looked at is a basic valuation, an operating building, say, after 18 months it's existed to allow for some maturity, that is the complete letting before being sold off to an investor. The other two deals involve incomplete or planned properties and allow the risk of the development to be managed. These are called either forward commit or forward funds. So the first one we'll look at is this forward commit, sometimes known as forward purchase. This is due to the large amount of money required for development. So a lot of money to spend. Developer doesn't want to be speculative. What they will do is find an end buyer and say, this is my land, this is my project, these are the plans, and I'm going to build this. If I do, will you agree to buy? And they enter into an agreement at a set price. The developer will fund the development themselves, normally with bank finance or other sources of cash. Now, the advantage here for the investor is they have none of the construction risks. What happens if costs change during the development, or if there are unexpected delays? Well, they will get their end property, even if they don't have the capability or construction knowledge to develop one themselves. The agreement is quite simple to execute, although the purchase price will be higher than in a forward fund agreement. Forward fund is the final type of deal, or rather the third type of deal that I'm going to look at today, and it differs a little in that the end user takes on the risks at the start. They will give stage payments as the property is developed, and in turn they can decide the specification of the development so that it suits them and their requirements. This can be what the properties include, the individual requirements, such as particular landscaping, finishings to the apartments or common areas, amenities, or even special sustainable construction methods. The developer at this time might not need bank financing. We could make the scheme even lower cost for them, and the investor takes on that development risk. However, final installment payment will normally be once the scheme is completed, let and operating, and this requires also a lot of due diligence on the part of the investor on the scheme, the plan, the permissions, the solvency of the developer and their contractors. But as I mentioned, the end purchase cost will be lower. And finally, this graphic you see here is really what prompted my interest in this sector. I saw this advert by this company on a London subway train, showing the benefits of one of their schemes. This is in fact the company that I mentioned in one of the slides earlier. They're now called Quintain, but previously they were called TP. And you can see the appeal to those who do not want to risk the shark-infested private rental market. Here says, no more shall you have to deal with lazy landlords or dodgy agents. And here's it. Today we say yes to no deposits, yes to no fees, yes to utilities and Wi-Fi included. Okay. The advertising through new channels, Instagram, social networking, appealing to mobile millennials who do not want to commit to lengthy leases, offering a better service than private landlords. And you know, it's again a mention if something breaks, a technician will be on site to quickly fix. And these things, though, are also risk factors for the valuer. Demand could be variable. The pandemic actually saw a flight from city centres, albeit only for a short while. A highly mobile customer base is a risk to consider. Perhaps some might prefer smaller private landlords also for a more personal service. That is, I'm thinking of tenants. This poster is quite striking. It does look something like from a planned economy, maybe Alexander Rodchenko type style of art, perhaps. Yeah, but no, I was thinking about the age profile of who this is supposed to appeal to in London. Over 60% of tenants in these type of properties are aged between 25 and 34, according to some research I read, also from last year. And as always, we're thinking about risk. As valuers, we are thinking about the risk, as are the investors, or as are the lenders. And pre-lets can't quite de-risk a project the same way that if it were an industrial centre, a warehousing, logistics centre, 30,000 square metres of logistics space, for example, you might do a 10-year pre-let for part of that space, okay? Or a significant amount of that space, whereas you can't really do that with developing these apartments because you're only going to let to an end user who is agreeing to take a very small space, normally an apartment, and only for a relatively short space of time, say a year. I think it's a year is quite typical. Okay, so a whole host of specialist knowledge in regulation, specialist operations, local politics, etc. These things also have to be understood as part of that de-risking. But that said, for us here in the UK, investors see how in continental Europe and certainly North America, such investments offer diversity to a portfolio. And this, coupled with the demand for the end product, means that we're likely to see more of these in coming years. For now, it remains very much an emerging sector. It'll take some years, probably, to be able to get to some sort of local comparative data to help valuers. So now, when we talk about these 22% costs and 3% vacancy, simple application of capitalization rate, we're talking very, very simply. One thing I'd also say here is the supply remains only around 10% of that in the USA, in comparison if we adjust for population size. So there's definitely a lot of scope for growth, at least in the UK and definitely across Europe. Thank you for listening.